Good evening, everybody. Sorry for the delay. Normal Webinado connection problems. Tonight we got the great pleasure of having Mark Sebastian back with us. He always has very good information on option trades. He's going to show us how to do the big money option trades. So with that, won't use up any more time. Mark, welcome back to the Candlestick Forum. Anxious to see your information tonight.
I'm excited to be here. I'm really happy to be here. It's good to see everybody. Steve, thank you. Before we begin, we've got to do the standard disclosure. What you're about to see is for educational purposes only. I'm here to teach you. I'm here to make you a better trader. And we are here to do that. We're not giving legal advice. We're not giving tax advice. We're not giving investment advice of any kind, nothing personalized. If you take the information as education, become a better trader, but this is not specific investment, legal, or tax advice. So what we're here to learn about today is big money's biggest advantage and the secret you can use to turn the tables on them. And this is one of my favorite things to talk about because there's a lot of misconceptions about big money. And, you know, you see a trade come up, 1 million shares or 100,000 option contracts. Those are things that you need to be paying attention to, but they don't always say exactly what you think they're saying. And there's something to know about big money. All right. Big money is like a shark, a big shark. And, you know, you see a big shark go after a fish or a seal or something along those lines. And it grabs a hold and it thrashes left and right. And who is gliding along with that shark? The remora. The remora is following along with that shark. Why? Because like big money, that shark is sloppy. That shark is the king of the hill, so it doesn't care if it leaves aside some scraps. And frankly, all that shark cares about is getting the fish. It doesn't care about what's the best way for me to eat this fish. What is the most efficient way to eat this fish? And so because of that, all these sharks you'll see covered in remoras. And what are remoras doing? They're getting all the delicious bits of food, the scraps, that shark is too lazy to properly eat. And big money is very much the same. The big, huge houses are very much the same. They don't care if they leave some scraps aside. They don't care that they're doing it in the most efficient way. They're, frankly, a little lazy and a little bit fat and a little bit slow. And because of that, we can take advantage of what they're trying to accomplish. So now, before we get started, I want to show you an example of what we can see with big money. This is Hamco Corporation. This was from December, CCJ. Customer buys 10,000 of the 20 calls and sells 10,000 of the 27 calls. This is called a call spread. This is a big trade in Camco. At the time, I want you to notice it is trading 16 bucks. Right around here. Lo and behold, this trader buying the 2027 call spread, magically, not only does he capture that it's going to move above 20, but times it so that the top of the move in CCJ almost exactly matches up with where he or she sold their call spread. Sold the upper leg of their call spread. Pretty impressive, but it's just something that you need to be aware of. Big money is not stupid. but they don't always do things the right way. But this is a classic example of huge paper telling us, hey, something is going on here. And lo and behold, they literally bought the bottom of the market and the stock goes straight up. Doing this, I started this following big money, tracking these dollars, and I use $1,000 increments for my trades. $1,000 increments. Sometimes it's a little less, sometimes it's a little more, but generally speaking, I try to keep every trade worth about $1,000. And since we started doing these trades in late September, here's what we have closed. Now, I have some trades that are open. Most of them are going to end up winners, and a couple will end up losers. But tracking this big money, we're able to consistently follow along and make good dollars on big money. So here's what we're going to talk about today. Who is big money and why you care? How big money moves markets, and how you can exploit their weakness. And these guys have a huge weakness, and we can use it against them. And then at the end, I'm going to give everyone a trade that I like that will still be good for tomorrow. So who is big money? You know, when people think big money, anybody here watch CNBC? Anybody a big fan of CNBC or Bloomberg Television or Fox Business? I can see us all jumping at it. We're all huge fans of CNBC. You see the talking heads on CNBC. Yeah, no, I'm not either. Bloomberg's not bad. I'll be on Bloomberg every now and again to talk options. But you see these talking heads coming on, and they're usually just pitching their own book. Big money is not the people you see on CNBC. It is not. These people work at banks. They work at hedge funds. They might be market makers. But where they are is sitting upstairs in a room, probably dark. They're staring at, they might have 12 screens up. And they're behind they're behind that talking head, and they're pushing a button. So you're never actually going to see who big money is. But I can tell you, you'll know them by their trades. You'll know them by their trades. So why do you care about them? People do want to know what big money does, right? You'll see John and Pete Najarian talking about, oh, we saw this big trade go up. But they're only tracking the ones that are the top 100 names on CNBC that don't really make a difference. They're not tracking the real big money trades that take place in stocks that you've heard of, but maybe don't trade as often as you might think. And they are finding areas and exploiting them. So the key with big money is we can discern their moves. And in discerning their moves, most of the time, we can decipher exactly what a stock is going to do. Big volume trades can act as a magnet for more volume, and they can actually push the stock up or down. Are you guys not seeing my screen? Are they seeing my screen? I want to share monitor. I want to share monitor 1.
Yeah, it's,
And
market's just flipping on and
yeah.
off. Right now it's off. All right.
All right,
Now
so you guys are seeing my screen now. All right.
Yeah, I'm seeing why should we care about big money?
All right, so we're there now. Good. All right. Someone was saying, I don't see anything. Sorry. Yeah, and so that's the thing, is that big money acts like a magnet. And, you know, I know you guys are big candlestick traders. You guys love your candles. And I got to be honest, I love candles too. But if you follow big money, you'll find that there is a nice correlation between what they're doing, the timing of that doji, and the timing of that giant trade. When they meet up, that is an absolute winner. You're going to have a very, if you're able to match big money with some of the things that you guys are doing here. It's very important. So here's an example. This is IGT. IGT is a gambling machine maker. And we saw, we saw a pretty big trade go up. We saw a customer come in. They were buying the 21 calls. They were buying the 23 calls. And against it, they were selling the 30 calls. And all this paper going up on the same day. All this paper going up on the same day. What did we have? We'd had a shooting star. For those of you that are chart people, if you can see this, we'd had a shooting star. And then on this big green candle, look at all this paper flow. Buying calls, selling calls against a different call. So this is a 21-26 call spread. We got the 23 calls being bought with it. You've got the a close of the 19s, and you have more of the same paper going up. The Jan 21-27 call spread being bought. The Jan 21-27 call spread going up again. So what's going on with IGT here? Well, pretty simple. Big money is saying this thing is not just going to go up a little bit. It's going to go up a lot. And so what did I do? I looked at what they were doing, saw the November paper, I saw the January paper, and I bought the 20 calls. I put the trade on the 24th of August, and I was out by the next week, and I'd made 50%. Pretty easy trade. And this is an actual trade. Put up the dollars. All right. So where can I find this type of data? And there's a way to screen for the significant activity. I'll tell you. So now, here's the beautiful part, though. Big money has a weakness. It has a big weakness. Big money cares about the stock. They know stocks. They know that IGT is going to go higher. They know that CCJ is going to go higher. But they're lazy. They don't know options. They know options provide leverage. They can put out a little bit of money and make a lot. But because these people know the stock and not the options, I'm going to teach you how we can turn it around on them. Sometimes smart money does dumb trades. That's the facts. And one of the things that we're going to teach you about is that you need to look at this smart money, recognize that they don't know options the same way you do, and we're going to trade it better than them. So it isn't that they make bad choices. It's that they don't care. Again, these guys are lazy. A name like IGT or Camco has 16, 17, 18, 19, 20, 21, 22, 23. It has a strike every single dollar. And in the example I showed you earlier, they bought the 20 calls and sold the 27s. Why? Well, the 20 calls that's a nice even strike. I can get a lot done there. They sold the 27 calls. Why? Because they knew that's where it was going to stop. They didn't think about, hey, is this the best way to do it? No. What they care about is, one, getting filled, and two, getting that leverage. So they don't care about the option itself. They care about the move in the underlying stock because these guys know stock. They're playing a totally different game than you and I. They don't worry about optimal risk reward. What they care about is, can I get 20,000 of these done at this price? So basically, they find a trade they like enough, and they call it a day. Anybody here do that? You guys are all trading your own money. Does anybody here say, this trade's good enough, I'll just do this? Does anybody here do that? I'm going to go out on a limb and say, if your answer is yes, you're probably not doing very well so far. Some big money has totally different motivations. They want to hedge. They're not actually thinking the stock is going to go in the direction of the trade. I'm short stock, so I'm going to buy calls to protect my upside. I'm long a ton of stock, so I'm going to buy puts to protect myself. So the thing is, big money trades may not be about the trade at all. So two big takeaways here. Big money does not care about optimizing their trade. They don't. And why? Well, these guys are mostly on a salary plus bonus. They're not risking their own dollars. These guys are at hedge funds or banks. You know whose money they're risking? Yours. You, the depositor. You, the investor. And two, they might be hedging, and the trade, right, might just be for an entirely different motivation. So here's an example. This is XLE. It's the energy stock. This is in October. And we saw a customer come in and buy 20,000 October 48.5, 44 put spreads. They paid 65 cents for the 48.5 calls. They sold 20,000 of the 44 puts at 15 cents. If you don't know where to look, you would think this is bearish, right? You see a put spread go up. Everyone knows this, right? You buy puts, you expect the underlying to drop. Well, what if I told you that at the same time that they were executing this trade, they were buying 400,000 shares of stock. Would that change your opinion on the trade? It would change mine. And lo and behold, what happens? What happens? The stock goes up, it doesn't go down. So what you're looking at here is a hedge and not a bearish bet. The trader actually thinks the stock is going up, not down. The thing you've got to remember with hedgers, people that use options for hedge, they expect the stock to move the other way of their option trade. If they thought the stock was actually going to go down, all right, I'm a big, huge hedge fund. If I thought the stock was going to go down, you know what I would do? Would I buy a put spread? What would I do? I just sell the stock. So you can't just look at big option trades. And this is one of the things that they do on CNBC all the time. You can't just look at big option trades in XLE and think that it's going up. Or down. Or that the option trade is right. Because there's a deeper meaning sometimes. This spread is bullish. Because they did the stock. All right. So here's where we can make our money. This is this hands us an opportunity to watch what they're doing and do it better. We can avoid tracking the trades that are hedges or have some other meaning. We can avoid the big option trades that are closes and only focus on the trades that are overtly bearish or overtly bullish and jump on them. So, big money meets smarter money. This is what we're going to do and what I'm going to teach you how to do. All right, I'm going to give you a straight up example of this. So I've seen and made money on thousands of big money trades. I've witnessed their mistakes and spotted the patterns. And I can tell when big money trades are optimized and when they're not. And as you saw in my track record, I have a proven track record that retail traders like you can make smarter trades off of what big money is doing than big money is doing itself. And because we're small, because we're only buying 4 or 5 or 10 contracts, we can slip right in underneath the market makers' noses while they're paying attention to this 10,000 lot. That's a great question, FT. I will get to that. So you can join me in big money, and I'm going to show you a big money trade here in a second. So big money flow helps you trade even smarter than smart money. And what I do is I show you how to use smart money to create your own trade and then teach you how to optimize it. And this isn't just some trade picking, all right? What we're doing is honing in on huge trades and then executing a smart trade based on what that big money is doing. Give you a couple more examples, all right? So we use a 3-step indicator, all right? So indicator 1 is the trade. The trade hits our scanner. All right. Our scanner enables us to spot unusual order volume and alerts us when an exceptionally big trade crosses the tape. Anybody can do that. You can go on TD and find big trades, I believe. Now, here's the part. I'm going to show you how to do all this stuff in a second. Step 2 is the confirmation, and this is important. You know, with candlesticks, we like to look for an option pit, and I know, Steve, probably pretty similar. You know, it's not that you got a doji. It's that you got that confirmation the next day that you can then jump on it. Big money is the same way. We just confirm it a little differently. So you can't just spot a trade and say, I'm going to do it, right? Remember, I showed you that XLE trade. The option trade by itself doesn't tell you everything. So we need to ascertain a couple of things. All right. Was this an opening trade or a closing trade? And this is sometimes easier said than done. All right. And then we need to make sure that we can tell if the trade is indicating a bullish or bearish sentiment toward the underlying based on figuring out whether it was opening, whether it was done with stock, whether it was a hedge. And I'm going to show you how you can do that. So then we get our authentication. We don't simply stop at spotting and confirming. All right, we then authenticate it. This is the final piece. All right, we make sure that we look for a driver behind the story, a news story, a catalyst event. Could be a chart. But we always make sure that there is authentication of the trade. Again, I just want to point out how well we've done. This is starting to turn into, and I've got more that, like I said, that are open. You know, Intel, I can't lose on Intel. I can't lose on almost every trade I've got open. And what I like to do when I'm trading, and this is something for you guys to think about, when I put on a trade, if I make a decent money easily, I'll just take the trade right off. But if the trade slowly makes money, what I will do is I'll sell half my position up 50%. Sometimes it moves against me and then I get out. Or I'll sell half of my position up 50% and then we'll sell more of it up 100% and then we'll let the last one ride. So for instance, I have a trade on in Pfizer. I'm long the February 55 puts. I'm still long these. And the February 55 puts, the reason why I bought these was because we saw huge paper coming in, and they're still coming in, and there's still time to jump in on Pfizer puts, by the way. Joey, you're not wrong. So Pfizer, we've seen customers buying the Feb 50 puts, the Feb 55 puts in bulk. So Pfizer, I buy the Feb 55 puts for $1.70. 2 days later, they're trading $3.30. I sell half my position, and now I can't lose. I'm up almost 100%, and I'm still open on 2 trades, on 2 contracts. So here's a couple of examples. This is Macy's. And this is one that is not on our official track record. This is when I was trading to build the track record to show that we had an option. All right. So big money. We spot a huge trade in Macy's. Details confirmed. Opening trade, no mitigating stock trade against it. Story authentication, Macy's owns a ton of real estate in an inflationary period. Inflation is good for real assets. The stock has been pounded, but the reopening trade was picking up steam. We also know earnings are coming up. So what do? We optimized our trade, and we bought the September 19 calls. I bought 5 of them, and we closed them out on October 20th. Trade gained 71%. All right, now, here is the final piece, and that is optimization. All right, you need to optimize your trade. I'm going to walk you through optimizing a trade here in a second. But this is really kind of the final step. It's not part of our big money flow. This is kind of what I do, right? I'm a market maker. I'm not a stock guy. I leave that to the big money people. What I am is an option guy. So I can look at an option trade and figure out whether it was the best way to express that opinion. So I'm going through, okay, what is the best way to execute the trade that big money just did? And I'm looking at things like, likelihood. Is there a way to make a trade with better odds? Is there a way to spread it? So this is where we beat them at their own game. We trade better options than they do. We trade better options than they do. Although I will say this KSS trade, I bought the October 29 calls. And I'll show you this. This is actually pretty funny. I want my chart. So we're going to go back to October. So I executed the trade in the losing trade. I'm going to walk you through. I executed the losing trade around kind of the middle of October, early October, and the stock immediately dropped. It started to get close to ending up in the money. These were the 50 calls. These were the October 29th 50 calls. But in the end, here we are October 29th. They ended up out of the money. Take a look at what happened starting the following Monday. By November 3rd, if I'd done the next week out, I would have made 300% on my calls. Just unbelievable the way that went down. All right, so here's one that was our first trade, RDS. We spotted a big, huge trade. The customer that was right closed and rolled higher. And this is actually one of my favorite trades. Why not roll them? Because I just kind of, at that point, I could have, but they were kind of worthless. So I was just going to let them roll off. So one of the trades that I like best, and we used to talk about this on the floor, and this is something to take home. Pay attention to traders that close winners and roll higher or roll out to a bigger strike. So what do I mean by that? So let's say you see a trader sell a call spread in a name like Ford. So for instance, yesterday, we saw a trader sell the January 21, 25 call spread in Ford. If I sell a call spread, is that bullish or bearish? Am I expecting the stock to go up or down? Just on its surface. Right, you guys are answering down, and that is the correct answer. Now, what if I told you this? What if I told you the trader owned the 21 calls already, and he or she sold the 21 calls and then opened the 25 calls? So the call spread wasn't actually selling a call spread, it was closing a winner and opening up a new trade. Now, would you say that is bullish or bearish? Is that someone you wanna follow along with? Right, we follow along with Steve because we know he wins a lot. Well, big money is the same way. You find the traders that win and you jump on board with them. So yeah, same thing. We saw the customer that was right, sold some calls, and then opened a new position. The oil was strong, stock was below its last peak. We bought the October 15th 46 calls. They were the cheapest option on the board. They made 125% overnight. It was absolutely beautiful. Here's that Macy's trade. I don't know why these are out of order. Here's another one, Taiwan Semiconductor. Look at this, Taiwan Semiconductor trading around 110 bucks. Why in the world is someone buying the 119 calls in September? Well, you tell me. The stock gapped and blew higher. This guy made a fortune. We spotted the trade, we tracked it. All right, so I'm going to tell you what I'm going to offer you here, and then I'm going to show you the actual process I use to break down a trade. You're going to see exactly what I do. All right, so if you join me, and I've got a special offer for you guys tonight, you're going to get 2 trades a week, and they're going to be optimized and authenticated, sent right to you. We text them to you, we email them to you, we give you a full trading plan. We trade a $20,000 portfolio. Each trade is about $1,000. You can adjust the sizing to how big you want to trade. You get 2 live sessions with me that are an hour long every Tuesday and every Friday. So we're going to be on tomorrow at 11 o'clock Eastern time. Every day, I give you 5 trades that I spotted that you can potentially piggyback and make money off of. You get 24/7 access to all of our replays, all the educational materials that we have for you on Big Money Flow. I have a custom Big Money Flow trading course there, and I have a using volatility to trade for direction course so that you can jumpstart your way into Big Money Flow. And this is the first time I'm ever doing this. We normally only sell this as an annual rate, but I'm going to do $99 per month continuing. So $99 a month. You can cancel out the first month. Heck, you try it for a week or 2 and you hate it, I'll give you your money back. I don't want customers that don't want to be here. And again, you're getting optimized 2 trades a week, maybe a little less around Christmas. You're getting 2 live sessions with me a week, daily emails pointing out the top 5 big money trades that we saw, 24/7 access to my website. You're going to get that bonus of the custom Big Money Flow video education series and my using volatility to trade for direction video course. $36,000. For a year, we sell it at $1,500. I'm going to let you guys join for $99 a month. How do I handle earnings? So with earnings, my motto is trade to it, not through it. I will never, with rare exception, will I ever take a trade into earnings. I'll trade before and I will trade after. I don't trade through it. I trade to it. I don't trade through it. So essentially, I'm giving you a monthly rate that allows you to cancel at any time for $300 less than I sell the annual at. So you guys want to see a big money trade. Have I got one for you? So I'm pulling up my scanner right here. Scanner, you can find big money, huge trades just about anywhere. It's not hard. It's going through the process of authenticating it and trading it where I can really do well. And so, has anybody ever heard of a company called Oatly? Oatly Group. Does that ring a bell to anybody? Yeah, I'll show you everything I've got on if you guys want to see. So the beautiful thing is we literally text you the trade and we email you the trade. So you're at work, you're on your cell phone, you open up your trading app, you execute the trade. It's really easy. So here are the trades that I have open. I've got going through, I'm going to win on CCL. CCJ is going to be a small loser. Vodafone is up. I'm along the April 16 calls. IGT, I lost on this one. First Energy, Open Table, MPC, F, Ford, EWZ is probably going to lose. Pinterest is going to be a loser. We closed half of it for a win, but then it turned around on us really quickly. Nutrien, I'm now in a position where I can't lose on NTR. And I'm going to make, I'm holding out for like $7 on my last call. UMC, same deal. I already sold half my position, up almost 100%. So I am just waiting until January to see if I can, to see where this goes. JMIA, I sold half the position up about 50%, and then the stock turned around on me. I'm going to lose. Uber, we made 108%. KHC, we did 50. Coupany, we sold half our position up about 60%, and then the stock turned around on us. So I might take a small loss there. Here's that Pfizer trade I told you about. I've already sold half my position up over about 100%. And then MGM, I'm still sitting on. Those I think I'm going to end up winning. Intel, we executed we saw big money right before the stock popped. We bought the 55 calls for $230, 4 of them. That's about $1,000. I sell 2 of them at $330. I sold 1 more at $380, and I'm working on my last one at $4. It's going to be a nice win. And then Uber, we re-entered an Uber trade. I bought the January 28th 43 calls for $1.47. I sold 3 out of 5 of my position at $2.24. I'm sitting on 2 more. All right. Now, let's get back to Oatly. Not one you would normally think about, but I want to show you this trade because this is one that you would not normally see. I'm going to show you the statistics here. So, Oatly has an average daily volume of 5,000 contracts. That is not very much. Today, total volume, 32,000 contracts. Where? Take a look. Customer came in and bought 10,000 of the 7.5 calls for $280. And against that, they sold 20,000 of the 22.5 calls. That's called a 1-by-2 call spread. Net, they paid $1.76 to be long the 7.5 calls. And they can't lose until about 35. I'll show you what this trade looks like on the screen. This was this is Jan 2023. So I'll show you what this looks like. All right, now, here's what the trade looks like. You think this customer is bullish? Yeah, these are leaps. You think this customer is bullish? I do. Yeah, give me a try, guys. There's the link. Give me a try. Like I said, you try it for a week or two and you hate it, we'll give you your money back. 99 bucks is no skin off my back. All right, and I want to take care of candlestick customers. All right, now, here's the next part. Is that trade opening or closing? Well, there are a total open interest of 466 contracts against these Oatly 7.5 calls and 275 against the 22.5s. So yes, this is an opening trade. All right, now, was there any stock done with it? And what I'm looking for is some tags that will tell me if this was done with stock. And the answer is no. So there's no stock, and it's a 1-by-2 call spread that looks like this. This customer, I will make you money. That's my, or I will, excuse me, I will help you make you money is the better way to put that. All right. So now, here's the next piece. Is this the best way to express that opinion? All right, well, this is where volatility comes into play. So now I'm going to pull up the actual options on Oatly. And what I want to know is, okay, is this the best way to express that opinion? And what am I looking at to determine that judgment? The answer is, I want to look at implied volatility. and looking at where implied volatility is landing, I can do this trade, I think, better than this customer. And this will be long dated, but it's going to be cheap. So the trade I would build, and I'm going to build it for retail traders. So he paid $1.70 for that 1x2. Remember, $1.76. The cheapest option to buy in 2023, which is the cheapest contract month, is the 12.5 calls. I'm going to pay $1.40 for the 12.5 calls. When I look at implied volatility, I'm going to get the best juice selling the 25 calls. They're worth almost as much as the 22.5s. I'm going to get 50 cents for those. So now, here is my trade that I would set up in Oatly. I'm risking 90 cents, and my return is $1,160. If I'm right. This is Jan 2023. I will write the trade up. We're looking at an OTLY, Jan 2023, 12.5, 25 call spread, paying 90 cents with a $1 top. This trade is going to have just as an easy time making money as that 7.5, 22.5, 1x2 call spread, and it's better. And it's better. All right, so one more time, let me tell you what you're getting here with big money flow. Yeah, 90 bucks. Bucks, you're going to make $1,100. You pay 100 bucks, you're going to make $1,150 instead of $1,160. So again, you're going to get 1 to 2 optimized trades per week. You're going to get 2 live sessions with me. And remember, those optimized trades, we email them to you and we text them to you. You're going to get daily emails with big money flow, an explanation of what's going on, so that you, as you are learning, can take advantage of those trades I'm sending you every day. You're getting 24/7 access to our, is there a phone number? Yeah, there is. 888-872-3301. And if we don't pick up, leave a message and my team will call you back in the morning. It's 8 o'clock at night, 9 o'clock Eastern. Do you know how much that's per year? Per year. All right. So when I go out, when a customer comes in and asks with them and help them optimize a trade, I bill at $1,000 an hour. You're getting that 24/7 access to our website. So that $25,000 is me. Will the deal be around tomorrow? I can't. Yeah, this is good through tomorrow. And you're going to get that bonus of the custom big money flow education series and using Vol to Trade for direction video course. It's all right, Rajesh. Give us a call in the morning and we'll take care of it. All right. So guys, again, here's that link. I'm dropping it in chat. I want to thank everybody. I'll take questions now. I know I saw a question that I wanted to answer. Insider information is real. We think it's only illegal if you get caught. Sometimes it's not insider information, but sometimes it is. But remember, these people have 50 researchers working for them. So here's a question. FTS, do they initiate large trades because they know where the stock is going, or does the stock go because of their large orders? It's actually a little bit of both. They buy these calls or puts because they know where the stock is going, and then that order acts as a magnet, and it starts driving the stock higher. What other questions do you have for me? How do they know? Because they can see stock flow, because they have 50 people working for them doing research, because they know some sort of event is coming up. I'll tell you, if I knew exactly how they knew, I'd be working up there. Yeah, when you see a bunch of calls go up, that can act as a magnet for more orders. Straight up. How do I determine if it's a hedge on a stock sale or a purchase? Based on where the trade is placed, whether there was stock done with the trade, and the structure of the trade itself. Do the alerts, the emails we send out explain it? And I send out a short video every day. When I do a trade, we email you a short video where I walk through the entirety of the trade, the entire plan. So on Oatly, again, I showed you it's opening, but then I'm looking at these implied volatilities right here. See, it says mid-IV. And what I care about is, where's implied volatility cheap and expensive? And so I'm going to show you something called a skew chart. Here's Oatly. These are the 7.5 calls. This is the implied volatility on the 7.5 calls. Here are the 12.5 calls I told you to buy. I told you I would buy. Here are the 22.5 calls they said they sold. Here are the 25 calls that I would want to sell. I'm not, Sam, man, we're not really trading against market makers. We're trading with them. That's the thing. I don't know if I can make this any bigger. Here, we can maybe do this. There you go. You should be able to see that now. So the thing I want to do is buy this call that's cheap, and I want to sell this call that is more expensive than the one the trader did. I like the trader's trade, but I just think I can do it better. So on the left is implied volatility. On the bottom is the strikes. The trader bought the 7.5 calls, sold the 22.5s. I am buying the 12.5s and selling the 25s. Well, what distinguishes you from Pete and John Najarian's option service? Well, one, I'm actually taking the time to find real trades that you can jump in on. And two, I'm confirming, I go through that entire process of confirming opening and closing the entire process. And tomorrow, tomorrow I'm going live at 11. So if you join tonight, you're actually going to get to join me tomorrow at 11 Eastern. So you can come tomorrow, and if you hate it, we'll just give you your money back. But I'm going to tell a story about those guys tomorrow. I've known them for a very long time. How is your trade better than the traders? The answer is in implied volatility. This trader bought, so implied volatility, I'm not going to go too deep. A stock price is the stock price, right? We determine the value of a stock by the stock price. You can't really do that with an option because it relates so much to the stock price itself. So what we use is implied volatility. And what I'm doing is I'm buying cheaper implied volatility. Let me erase my other arrows. And I'm selling even more expensive implied volatility. That is why my trade is better. Open interest doesn't matter. People think it matters. It doesn't. Yeah, I walk through trades every day in Monday Morning Live. That's true. Yeah. On your XLE example, you showed how 400,000 share purchase in addition to the high option volume. Is this usually the case with your scanner? Yeah, so that's something I check with every trade because I don't want to jump on calls when there's been a bunch of stock sold with it because that's not bullish the way that you think. My trade is 12.5 wide. His is 15 bucks wide. He will make more money well, remember, he paid $1.70 for that $15 spread. I'm paying 90 cents for a $12.5 spread. So my return on capital is better. I'll tell you, because this is Jan 2023, if this stock goes to 13 bucks, I'm going to make a lot of money. And I'll show you. Let's take a look. Here's my spread. I paid 90 bucks for it. If it goes to $13, I'll be up over 100%. Now on a $90 trade, I'm going to buy 10 of them. So if it goes to 13 bucks and we're up $1,400, I'm going to take some money off the table. Yep. So I'm happy. So I'll take, at 13 bucks, I'll take off half my position. And then I'll spend 900 bucks. I'll have sold enough where I can't lose, and I'll let the rest run. I'll sell more when it gets to, 15, 16, and then I'll let the rest run all the way up to 20 or 21 or 22. Of course, yes, I take theta into account. Part of the reason why I'm doing this as spread is that it has reduced theta. And look at this. There really isn't a lot of theta to this trade. It's losing 90 cents a day. Is my trades always 10 contracts? No. My trades are always valued at about $1,000. What's my normal duration? The average length of time in a trade is going to be about 1 to 2 weeks, but I will have trades that I do out in April, that I'll do months out. So this Oatly one, this could be a 6-month trade. Yeah, I'm trading the dollar value, Joey. So if I do every trade as $1,000 and you've got a smaller trade, you've got a smaller account, you can do $500, you can do $250. Nobody has better jokes than Steve. My jokes are a lot like Rapunzel. The only difference is instead of, Rapunzel lets down your hair, my jokes just let you down. So there you have it. All right, guys. It's 8:15. Thank you. Thank you. Well, Art, you could do $100,000 at it. We have traders where I do $1,000 and they do $10,000 per trade. Valentino just went to bed. But I want this service available to everybody, and not everybody has $100,000 to throw at every trade. Heck, I don't have $100,000 to throw at every trade. I'm gonna have losers. So, I've been winning at about 70, 80%, and I expect that to continue. Do I use a broker that doesn't charge commissions? No. You can, but I don't. And I'll teach you some execution tricks in options that I think you guys are going to really like. All right, guys, it is 8:15. I'll drop that link in one more time. I want to thank you guys for being here. And here's our number one more time. If you want to call us tomorrow, we'll take care of you. Hopefully, I see you guys tomorrow at 11 Eastern. All right. Normally, I don't like to lose more than. Normally, I want to lose less than 50%. All right, guys. I hope everybody has a great day. Steve, thanks for having me. You guys are great. Have a wonderful evening.
Thank you, Mark. Everybody, the reason we have people like Mark on our chat rooms is they have produced good trading strategies for years. So a lot of people always ask me, well, why do you have other people on your Thursday night chats? Because you can look at somebody's system and say, well, that's pretty good, or I think I understand it. But then you look at somebody else's system and say, wait a minute, I really understand this. And the advantage of candlesticks is you can apply it to any trading strategy. So Mark's systems have been working very well. That's why he keeps coming back here. That's why we keep having him back. So here's your risk reward factor. I guess your risk factor. Try it for 99 bucks. That's now a steak dinner someplace. You can see whether this fits into your trading strategy. And again, because Mark has information where the probabilities are always in your favor, that's where you want to be in with investing. So Mark, again, very good stuff. Try it. You're going to get more than your money's worth. All right, everybody, have a good evening. Mark, thank you very much. We'll see everybody in the chat rooms.